In this video, we discuss what you need to know about retiring during a market crash. Coming up next on Holy Schmidt.
Holy Schmidt!
Gone are the days where we can count on our cash flow in retirement with something called a defined pension plan or a defined payment plan. This is something that our grandparents had back in the day. If you have one of those, count your lucky stars. And if you have one of those that is inflation adjusted, well, the universe is on your side. For the rest of us, we need to know what to do during a market downturn. And that's what this video is all about. But before we begin, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. There's a lot going on in the world right now, and I work very hard to get what's out there and here for you. All right, let's jump into it. This video will give you some of the big ideas that have stood the test of time. And even though it doesn't feel like it for you right now, we have been here before, in fact, many times before in the history of this country, in the history of the world, in fact. Let's start off with an obvious acknowledgement of how you're feeling and also an acknowledgement of what's going on. When markets become destabilized, it can put a damper on years, even decades of retirement planning. Do you remember when your 401k plan representative came to your place of employment and asked you the following question? What is your risk tolerance? Low, medium, or high? I don't know about you, but for me, when the question came up, I was in my early 20s and I checked high. Let me know what your choice was in the comment section below and also how you're feeling today. I'll remind you at the end so you don't need to stop the video to do this now, but I want you to feel better about that choice because I think you'll find that a lot of people made the same choice that you did, and the only way to tell is to read the comments. All right, back to the video. This question, by the way, is a great place to start because if the world fell apart tomorrow, the back half of the year and the year after that, would you panic sell or would you have the fortitude to stick it out? The answer to this question is an important one and it actually frames the rest of the discussion we have here. No matter what your answer, the number one thing to do right now, and if things get worse in the future, is don't panic. Panic is not your friend. Panic without a plan means that you're swinging blindly and trying to hit something in the mist and you have no idea what you're swinging at. And generally that means panic selling. Sometimes the worst thing you can do, in fact, most of the time, the worst thing you can do is to panic sell because you think that things are going to get a lot worse. Don't get me wrong, there are times to sell your assets and there are times to hold your assets, and maybe now is the time to sell some of your assets, but you need to think this through logically and methodically before you do. And it's hard to stay balanced and focused when there's a lot of shock information out there. I read one recently that said that right now you should have 2 to 4 years of cash on hand to weather the storm. This begs the obvious question, where was that advice 6 months ago when the markets were riding high and you could actually sell your investments and not take a big loss on what you have in your portfolio? The advice back then was 3 to 6 months, maybe a year if you're ultra conservative. Now it's 2 to 4 years. How do you bridge the gap between 3 months and 4 years without selling something below market? Headlines like this scare the heck out of people and they sell a lot of magazines and newspapers. But hypothetically, let's just say that you followed that advice and you sold 4 years worth of cash and you put it in your savings account and inflation is running at 8%. What happens to that 4 years worth of cash? By the end of the 4 years, it becomes more like 3 years worth of cash or 3 and a bit. So be very diligent about how you withdraw your money because frankly, just selling wildly is not the answer. And if you're watching this video and you're in retirement, which is most of you, right now it makes sense to sell less of your assets, not more, because you are selling at a depressed price. If the market is down 20%, you're selling 20% more total number of shares, 20% more units if you're talking about a mutual fund or a limited partnership. The point is that that seed, that unit, that share, that element in your portfolio goes up and down in value, and when it's down you need to sell more of them to get the cash flow that you need to pay the big bills. The better strategy is to look for ways to reduce your spending. It's not forever, but it is right now. If you had sold your portfolio in 2009 or 2010 when the market crashed, you would have sold at 60 or 70 cents on the dollar, only to see that rebound a few years later and take off and double in value, more than double, frankly, over the next 8 to 10 years. If you're worried about the decline in your portfolio, Now might not be the time to take the bucket list vacation to India, to dine in the Russian tea room on 57th Street in New York City, or to fly business class to the family reunion. We all have things that we want and all have things that we need. If you're lucky in life, you'll get the things that you want and the things that you need, but right now focus on the things that you need. And the S-curve, for those of you who know what that is a great place to start. If you don't know what the S-curve is, I'll put a link in the description to the S-curve. It's on my website. It's called the Schmidt curve, and it talks about basically the difference between needs and wants in retirement and how to satisfy as much of those that give you the best utility or the biggest bang for your buck at the lowest spend for the bang, so to speak. The next point is to look for other cash solutions. If the market is dropping and inflation is raging, getting creative with your cash flow is pretty important. If, for example, you can buy something today and pay it out over 3 payments of, say, 3, 6, or even 12 months, basically you've taken the inflation element and you've put it on somebody else. Don't get me wrong, you can't actually take that cash and spend it and not have it available for the purchase later, but you can, in fact, move your cash around so that you can spend your cash today on what you need today and your cash in the future on what you need in the future, and not confuse the two. If you have a great mortgage, paying off your mortgage early may not make a lot of sense right now. If you're paying 3 or 4% on your mortgage and inflation is running at 8 or 9%, well, the value of the mortgage to the lender is going down by 8 to 9% per year. This is particularly true if you have to sell assets at depressed prices to pay more on your mortgage than the required minimum. Many financial advisors will tell you in this scenario it's better to keep the cash and use it to pay your bills, or to keep the cash and use it to reinvest or stay invested, as the case may be. And we are in inflationary times. Not a lot of things are on sale right now. That is because there are more buyers than sellers. When there are more buyers than sellers, prices go up. If there are more sellers than buyers, prices go down. Think about fuel. When Russian oil was cut off, the same number of people still needed to get to work, to get to their family vacations, or to get to a friend's house by car, yet there wasn't as much fuel, so you have basically less supply with consistent demand and prices go up. However, if you have the ability to buy something today and lock in prices for the next 12 months, it might make sense to do so. I'll give you a great example. Right now it's June, almost July of 2022. There are things that you buy in the spring that you'll definitely need in 2023 that you could buy now for a lot less money. This is because vendors have cash flow issues just like everybody else. And if they have inventory that hasn't sold, well, they're going to sell it to get the cash flow, particularly now, and redeploy it for something else. Think about things like garden supplies. Heating oil, if you heat your home with heating oil, a long-term contract with your heating oil provider in June might get you a better result than if you wait until September or October when winter starts to approach. But you only do this buying early or locking in a long-term contract if you are sure you're going to use the product or service. The worst thing that you can do is to agree to buy a product or service at a price, and that price is locked in for the next 12 months, and you find that you are obligated to buy it, but you have no use for it. Now, if you must sell your investments, and I recommend that you talk to a financial planner before you do this, but if you must sell your investments, this is the order that you should consider. First, dividends and interest. As they're coming out, instead of reinvesting them, use those as cash flow. If you must sell investments, focus on low volatility investments like treasury bills or treasury notes of 1 or 2 years. Those shorter duration notes are going to retain most of their principal even when interest rates are rising. Maturing CDs are a wonderful place to access cash because you won't have lost your principal on those. You have just received less interest than you would or could today. And if you must sell investments, sell the ones that you would have sold anyway, and look at ways to cultivate your tax losses. It's impossible to say what the future holds, but minimize selling during a downturn is important to make sure that you have the assets available for you for the long term. Even small reductions in the amount you withdraw from your savings or your investments will go a long way to helping you in the long run. All of this, as I mentioned at the beginning, is predicated on you speaking with a qualified financial planner who can look at your specific situation dispassionately and help you design a strategy that's right for you. Also, remember to fill out in the comment section below what you chose when you implemented your 401k, low, medium, or high risk tolerance, and how you feel today. Even if that is the choice that you still have today, how you feel today. I think you'll find that a lot of people will have a big mismatch between those two. Just put it in the comment section below. The world is a strange place right now, and I work very hard to get what's out there and here for you. So please consider clicking subscribe and clicking notifications so that you get alerted when I post a video. I post about twice a week. Also, check out this video on several reasons why you should not repay your mortgage early in this day and age. This is Jeff Schmidt. Thanks for watching.